Welcome everyone, this is John Sheely at Traders Country Club. Today we're going to take a look at the stock market. And the question is the stock market about to have a very large correction from the highs? However, before we start, we have to review our disclosures. There is a high degree of risk in any type of trading. This could be either stocks, options, commodities, or forex currencies. And trading is not necessarily suitable for all investors. Past results are not indicative of future returns. Now what I've done, I've put a weekly chart of the Dow Jones, and as you can tell, prices have rallied now for all of 2017, and we are extremely high. Let me put an indicator that gives you an idea of just how far these prices have moved. What I've done is put three different indicators. Now these indicators are based upon the 50-period simple moving average, which is very popular in many stock traders. And this is 5, 6, and 7 average to range above the 50-period moving average in the weekly chart. Now you can see how high prices currently are above these levels. This is 7, 8 average to range above this area right here. That's extremely high. So let's take a look at the last 25 years to get an idea of what prices normally do. We'll start at 1994 and prices begin to move up. You can see in 95 that the area reached between 5 and 6 average to range, and you begin to have a correction. And this particular prices have basically moved down for another 4 or 5 weeks. Now here's the main thing. Do we expect a setback? Yes, but it's not necessarily very far. In other words, we have a correction when it's quote overbought, but not for very long. The trend continues on, but as you take a look at prices as they reach this zone, prices normally begin to have a correction. You don't know whether or not how deep it is, but you can basically make a bet here that prices are going to fall within the next several months. So let's take a look. Here are your 1995, two of these. Like again, prices reach into this zone. Here's your correction. Gets into this zone, a correction of 4 or 5 weeks. Another one. Here's basically sideways sitting back for at least 2 months. Eventually we have a rather larger correction here. Let's take a look at more history. Here we're looking at 1997. It's becoming into this area. Here's your correction. A correction that basically sits sideways now for almost 2-3 months. Now most of the price movements that you see in a bull trend doesn't reach this high. But we're just talking about what happens if they do reach this area of the Dow Jones. We're now looking at 2004. You get into between 5 and 6 average to range. Here is our correction. But it's been not having that kind of a large price run for several years here. Here's the 2007, and here is a correction of only about a couple of weeks. Another nice little rally, and then here's a larger correction. Of course, what we're looking at here is the big bearish trend that it continues in the 2008. Now, I do two things. Does that mean that we're going to have a correction that's turning into a bearish trend, something like we saw in 2008? No, that's not what we're saying. You have a lot of time to be able to decide whether or not you have a very large correction that turns into a bearish trend. We have plenty of time of knowing this. We're going to analyze prices week by week. If we do see a bearish trend continue, we're going to let you know. But no, all we're saying is based upon history, you're going to see a correction. Here we're looking at 2013. Here between 5 and 6 average to range, there is a correction. Now again, this does not mean that it is going to have a long-term bull trend turn and going bearish. No, all we're saying is that the correction is normal when prices reach into this area of the chart. Now let's take a look at our current price, 2017. Prices moved well above 5, 6, 7 average true range. It took a couple of weeks before we really had a larger correction. But again, it's not necessarily a huge correction, but it took at least, what, more than a month. Prices have now moved all the way up, but every time we got into the 5 average true range, what happens? Correction. Move up to 5, 6 average true range. It sits sideways for 3 weeks. Here's another one between 6. A small correction of about 2 weeks. Now what you're seeing right here is the largest run in the last 25 years in regards to how high prices have gone up. So, do I expect to see over the next 3 or 4 weeks we're going to have a larger correction from the current price area? That's 23,325 or so. Yes. Does that mean it has to occur this coming week? No. All I'm saying is if you are long, you may take some profits in regards to your portfolio. Do you put a new long position on, a new buy decision at this particular time in equities? The answer is probably not. Don't put new long trades on. Wait until you have a correction that is normal, and that should occur within the next 2 or 3 weeks. Now there's a few things I need to talk to you about how different the market is right now. Normally when prices move up, that the volatility of the weekly range increases. Makes sense, right? If prices get higher and higher, then the range of that stock or stock indexes normally go up. But that's what's not happening. Look how low this average true range of the weekly chart. You're looking at just less than 300. So in the average range of the week is less than 300. That's very small, but prices have not been so volatile as to move up. Slowly, daily after daily. One day's up 100, maybe 125. There's a down day. There's a couple of days. But you don't see huge spikes in daily price movement. So it's moving up, but very, very slowly. This is why you have seen that the VIX has not been extremely large. You are not seeing huge volatility at this particular time. That is why this is so different than any time that you've seen before. So, where do we normally expect? This is why you're probably going to see 22,500 within the next 4 weeks. Now, I've heard on television, not recently, about the crash of 1987. I want to show you this. This is the 1987 crash. Now I'm showing you a weekly chart right here. Now notice that prices reached into this area right here again between 5 and 6 average true range. This is actually in the early part of the year, and sure enough prices have their correction. Here we are between 5 and 6 average true range. And even in 1987, in August, here comes a correction. That's basically all we're expecting. But recently, I heard some people were talking about the potential of a crash similar to 1987. Notice that was interesting. When you're looking basically within 10 weeks, a complete collapse. But this is the weekly chart. You had plenty of time to analyze prices in the daily prices, and you would then see that you were seeing a bearish trend, and you would be able to avoid the collapse, something similar to what you've seen in 1987. Do I expect a collapse of this kind? Of course not. This would take a very unusual circumstance, just like we had in 1987. We're taking a look at the SPDR, the SP 500. Now that's 500 stock. So let's take a look. Here we are in the early part of 2017 within 5 and 6 average true range. Here's our correction. Here you're looking basically over the last 5 weeks, 6 weeks. Here comes the bull market. We are now getting into this some area in just before between 5 and 6 average true range of the SPDR. This is also very high any day that you begin to watch these prices on a rather large down move, you're probably going to see a correction of at least 4 or 5, maybe sometimes 6 weeks. Now, how do we trade this? As I mentioned to you this, do not take new long trade. I just don't like the risk to reward. Should I put on options? It depends on whether or not it's going to occur. Is it going to fall down? Have a little correction? Yes, but we don't know exactly when. Therefore, if you do some options, you're probably going to need to give you some room here, at least 2 to 4 weeks. And also, the correction that we're beginning to see, you don't know whether or not it's going to be collapse like we have seen previous years, or if it's basically something like this, just a correction of a 3, 4, 5 weeks. Of course, it depends upon the fundamental, as we discussed, of whether or not the Congress actually creates a tax cut. If they do not create a bill and we don't get anywhere, then this is going to increase the odds that the correction is going to be much larger. Lastly, I'm showing you the bonds, and the reason I'm showing you this is the 30-year bonds. It's trying to return into a bullish trend. Now, normally you wouldn't expect that. You would expect a strong bearish trend when you have a stock market that's this strong, but it's not happening. Neither is the 10-year note. So in other words, one way you can play that if the stock market falls, and especially if it's serious, the bonds are going to move up. So there's another way you can play and watch the prices of whether or not you're going to have a trade in the direction of a bearish trend in the stock market. You can trade stocks, or you can buy bonds, 10-year notes, because if the market falls, and especially if it falls hard, the Dow Jones may go down, but the bonds and the 10-year notes are going to move up. So watch this area as well. There's another way you can trade this particular position. This is John Shealy at Traders Country Club.